everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at OTIS Worldwide Corporation, ticker OTIS. This is an elevator company. Between the installation and the maintenance of elevators, they have a pretty good business here, and they seem to have quite the monopoly in that space as well. So let's dig right on into this. It's one that's been on my list for a while, and it's got some interesting things going on. Fair value coming up with 98. Current value, 98. Although that fair value is being driven up a lot by the cash flows. This one's got an interesting scenario where cash flows are super high, driving it, and the balance sheet is in horrendous shape and dragging things down, just not to the same degree. Earnings yield, 4%, kind of low, shows that it might be a little overvalued at the moment. Cash flow yield looks very good. They seem to sit right around 10.5% on that cash flow yield. Double digits, what we like to see. A dividend yield of 0.41, which is less than a third of what we typically see from this company, 1.3%. Payout ratio, 38.3. They have room to grow it. They're pretty good at growing it. Double digits. If anything, I classify this stock as a dividend growth stock. Although if they can't drive those revenues up, then they might have to slow down here. ROE is negative here because their debt to equity is negative because they have more debt than they have assets. So they have a negative equity, which means you own part of their debt. And I do not like companies like that. So I would definitely not be buying this stock. It might take a while for them to turn things around. I mean, as you see, they're selling off their assets. Liabilities shrank slightly in the last 2 years, but they're up in the last 3. So that's not a good situation with the balance sheet here. Potentially poor management is going to be the ruin of them. Margins don't seem too bad. We like 30 and 10. That's almost what we got this last year. We're just shy of both of those numbers. Although it does look like they were able to cut expenses because the net margins are quite a bit higher than the average, than the gross. Revenues, I mean, this thing seems to like 3% growth. 3.6 in the last 3 years for the compound annual growth rate. Analysts are expecting 3.5 and 3.6 for the next 2 years. So 3.5 seems like a very reasonable growth rate for the revenue. Share count, they are pretty good about buying back their shares. Buying back more than 1%, about 1.5% over the last 2, 2 over the last 3 years. So, I'd like it to be 1.75, but honestly, if they're slowing it down right now, it might only be 1% that they buy back, especially at a higher price. Cash flows, they seem to hold this yield pretty well. So if they continue to hold that, we'll keep that in our thesis of 3.4% growth on that. Assets have been decreasing. It'd be great if they were able to increase them, and we can take a look at the impacts of that after we run through this realistic scenario. Liabilities, small growth here. They did shrink them over the last 2 years, but to a small degree, and in the last 3, they actually rose by quite a bit in comparison to what they were growing in their revenues. Dividend, of course, it's going to slow down. 11% would be pretty good. That'd take them to $2.46. In 5 years, which would give you a 2.5% yield on cost. So that's nothing crazy. I'd really like a 3.5% yield on cost. That's kind of the sweet spot that I target for dividends. So if I were looking at this as a dividend growth stock alone, I'd be wanting a lower price for sure than where it currently sits. And around that 70 would probably be a good price. Yeah, around $70 would be ideal, the perfect price for me for that dividend. And then margins, small growth. I really want to see them get up above 10%. I mean, if we're realistic, they're already growing a little bit above average. So I do think slightly less than 1% growth per year is fair. I mean, that'd take them to almost 10% this next year. So that whole scenario, buying at today's price of $98.25, you'd be looking at a bit of a loss in the 3-year time frame and essentially breaking even over 5 years. The fair value is being elevated by those cash flows, which are important. So But then when we break it down to reality, it's not as crazy. In fact, so it looks like at this realistic scenario, not really worth diving into and buying up quite yet. If we can get it down to 52-week low levels, still not quite there for performance on par with the market. If we can get it down to our margin of safety level, you're now hitting the 5-year, essentially break even, just underperforming on the 3-year basis. So 65 would really be the ideal price here. Hasn't been that low in the last year or so. But now we can change some of these numbers and get a different picture. See if their dividend only came in at 10% raises. All of a sudden, we're underperforming in the 5-year as well, getting 7.36% annual returns. Liabilities, let's say they can just hold them where they're at, down to 7.45. If they can pay down their liabilities just slightly by 1%, we got a 0.2% annual boost. We are now on par with the market again, even with the lower dividend. So the balance sheet clearly is the large issue here for the company. Ideally, they turn positive on their assets. We can get 1% growth out of the assets and pay down the liabilities by 1%. We pull out another 3% over the next 5 years with an annual return of 8%, 8.2, just about. But let's dig into this balance sheet and see what the heck's going on. It looks like assets, they had a bit of a spike in 2021, but it's just very flat. There's not much growth. A lot of intangible assets, which I do not like. At least the liabilities, it's kind of a similar situation, although there definitely seems to be a bit more of an uptrend in those liabilities than there is anything in the assets. And so the tangible book value is negative here, and it's getting worse, which is definitely not something that we like. And then when we go and we try to look at all of the valuation metrics graphed out, I mean, we're seeing down here the laggard getting worse by the year is that balance sheet, but just continuing to trend negative, taking away from the value to shareholders and kind of punishing them. The fair value right here, trending below everything else. Cash flows are very flat. Earnings are on a decent uptrend, and the dividend is a nice linear growth there. So again, if anything, this is a dividend growth stock. I pay for the yield, make sure that they're not losing revenues, and based on analyst projections, they've got a bit of room to go with this dividend. It's currently at a 38% payout ratio. I mean, if they continue growing it at 10%, then they come to 2.35 in 5 years, when analyst projections for earnings in next year are 424. So that should keep them underneath the 50% payout ratio if they continue on the current trend. And that's all for this one. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.